Hey, what's up everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be exploring the differences between ETFs or exchange traded funds and traditional mutual funds. So if you've been investing for a while, then you probably have already had some experience with traditional mutual funds, but you might be hearing some buzz about ETFs or exchange traded funds and kind of wondering what is the difference, or should I be investing in ETFs or should I be sticking with traditional mutual funds? So here in today's video, I'm going to be talking about some of the pros and the cons of each type of mutual fund, and I'm going to be talking about some of the significant differences between exchange traded funds and traditional mutual funds. Let's begin by talking a little bit about some of the history behind these types of mutual funds. So traditional mutual funds have been around for a very long time. In fact, actually the very first mutual fund was created in 1924. Exchange-traded funds are actually relatively recently. The very first ETF or exchange-traded fund was created in 1990, so they don't quite have the history behind them. And actually, just like a lot of new products, ETFs were relatively slow to grow in the beginning, but here recently, ETFs have been one of the fastest growing types of investment products on the market today, and I think for very good reason. So I'm going to be talking a little bit about some of what I think are some of the advantages of ETFs. Now, the primary difference between exchange-traded funds and traditional mutual funds has to do with the way that they're bought and sold. So with a traditional mutual fund, if you want to purchase shares of that particular fund and nobody is selling your shares at that time, that mutual fund is simply going to expand and create new shares to meet your demand of the purchase. So that money and that transaction is going directly into the mutual fund. On the same token, if you want to redeem your shares of the fund, you're going to put that sell request in, and then that mutual fund is going to liquidate whatever securities they have in the portfolio to meet that redemption and give you your money back. And if nobody is willing to buy those shares, the mutual fund will just simply contract. So you have this open-ended mutual fund, as they're called, that's going to be constantly expanding and contracting. And that is the primary difference between that traditional type of mutual fund and an exchange-traded fund. Now, an exchange-traded fund works a lot differently. So with an exchange-traded fund, you're basically buying and selling shares with other shareholders. So if you want to buy shares of the XYZ ETF fund, hopefully there's somebody out there willing to sell you those shares. If there is, you're just simply going to buy those shares from that person who's selling. Now, if there isn't anybody selling the shares and you want to buy the fund, what happens is, just like with a stock transaction, you're going to go through what's called a market maker. So you're going to put in your request to say buy 1,000 shares of the XYZ ETF fund, and if nobody out there is selling shares, that transaction is going to go into a market maker. They're going to sell you the shares of the fund and take your money in exchange. What they're going to do is they're going to purchase the entire basket of stocks or securities that ETF holds, and then at the end of the day, they're going to deliver those shares directly to the fund company. So the fund will get bigger, but you're not doing the transaction directly with the fund company. You're doing it through either another shareholder or you're doing it through a market maker. So it's the way that these ETFs are bought and sold that I think creates several of the key advantages that ETFs have over mutual funds, in my opinion. So because that market maker needs to know what that entire basket of securities that the mutual fund holds is, then it creates a lot of transparency. So unlike a traditional mutual fund where basically they're only required to report the holdings of that fund on a quarterly basis, with an ETF, at any moment in time, with just a couple clicks of a mouse, you can very quickly find what every single security, every single holding of that ETF is. Because remember, that market maker needs to recreate that entire basket. So in order to do that, they need to have the transparency to know what exactly is in that portfolio. The second advantage that those ETFs have, because of the way they're bought and sold, has to do with the transaction cost. So if you think about a traditional mutual fund, every time you put money into a fund or take money out, usually something needs to be bought or sold. If you're buying into the fund, they're going to have to buy those securities that mutual fund holds. And that, again, is all done internally within that specific mutual fund. So those transaction costs are borne by all of the shareholders of that fund. So even if you're the the one that's maybe putting in a deposit of $10,000 or $50,000 into that mutual fund, that fund is going to share that transaction cost with all of the shareholders, which means that if you're an existing shareholder of one of those traditional mutual funds, there's a lot of those transaction costs that are constantly going on within the fund as people are adding money to the fund and taking money out. They call that net redemptions and net deposits within that fund. So that can get really expensive. In fact, there's actually a lot of articles over the last few years that have been written about what are called some of the hidden costs of mutual funds. In fact, if you actually just do a quick internet search for that, you'll find all kinds of information about that. It's really hard to get an idea as to how expensive some of those mutual funds are with those transaction costs, but there's a lot of different studies have been out there that have tried to make those estimates. So again, with an ETF, all of those transactions are happening outside of the fund. So your decision to either buy into the fund or cash your money out of the fund is not going to incur any transaction cost for that particular mutual fund. Now, another advantage of ETFs is the fact that you can buy and sell these ETFs throughout the trading day. So with a traditional mutual fund, all of your transactions are going to occur at the end of the trading day. So if you put an order in before the market opens or maybe right at the opening bell at 9:30 in the morning to either buy or sell that mutual fund, that trade is actually not getting executed until the very end of the day. Whereas with an ETF, ETFs are traded throughout the day. So if you like where a particular ETF or where the market is at 10 o'clock in the morning, you can place that buy or sell order at 10 o'clock in the morning and you're going to get executed at that particular time if it's an open market order. So that can add some pretty significant value, we think, especially when we get these really heavily volatile trading days. So I think many of you probably remember a little bit about what was going on at the tail end of 2018. We had the Christmas Eve big, huge drop, and then the market started rebounding. So on December 27th, we started off and we were down as much as 600 points earlier in the day. And then by the end of the day, the market had reversed and closed up 200 points. So, you know, if you were trying to take advantage of maybe that dip when the market was down 500 or 600 points, you would have gotten a completely different outcome had you put that money into a traditional mutual fund, because you would have been executed at the up price, not at the price that you entered that trade when it was actually down 500 or 600 points. So that can make a pretty significant difference. And for those of you that maybe want to be a little bit more active, that's something that could be a pretty significant advantage. So the last big difference between ETFs and traditional mutual funds has to do with the way that they're taxed. So if you have these mutual funds or ETFs, if they're in some type of a retirement account like a 401k plan or a Roth IRA, traditional IRA account, you don't really pay any taxes along the way. You only pay taxes on those monies or those gains as that money comes out, if it's in the case of a traditional IRA. And if it's a Roth IRA, as long as it's qualified, you don't pay any taxes on the distributions. So what I'm talking about here specifically is if you're going to hold these types of mutual funds in a non-retirement account. Sometimes we refer to that as the tax now bucket, because every year you're going to get a 1099 statement that's going to show you all of the capital gains, short-term gains, long-term gains, all the interest income that you're getting from that particular account or that particular mutual fund, and also the dividends that you're paid. And so mutual funds are required by law to distribute all of those capital gains every single year. And so let's take a situation here. So we know that, you know, as the market goes up and down, that can drastically affect how much money is going into a fund or coming out of a fund. So as the markets are going up, a lot of people are putting money in, and we see this all the time through, you know, the net deposits and the net redemptions on these mutual funds. But when the market drops, we know that a lot of people don't have the tolerance to stick with an investment strategy over a long time. So people start to panic and they start to pull money out of that fund. But let's say you're a long-term investor and you believe the market's going to come back and you're holding on to things for the long run. Well, the fact that a lot of other people are cashing out of those mutual funds, even though the fund might even be down in value, might trigger some capital gains that you're going to have to pay. And even though you're not the one selling the shares, they're still going to attribute a portion of those capital gains to you as a shareholder of that particular mutual fund. So you take an example here. Let's say that your fund that you're in the ABC traditional mutual fund, and they decided to buy Apple stock a couple of decades ago when it was really super cheap. And now, even though Apple stock might be down a little bit from where it was a couple of months ago, they might cash out of that Apple stock at a significant gain because they need that money to meet the redemptions. Well, guess what? You're going to have to pay a portion of that capital gain as a shareholder of that fund. And you might not even own the fund that long. So they might have bought the fund back in 2005, and you might have just bought the fund last year, but you'll still have to pay a portion of that capital gain, even though you haven't necessarily experienced that same gain over that life of the fund. So that works completely different. So an ETF is going to use something called an in-kind redemption process. So just like when you buy or sell the fund, oftentimes those buy and sell transactions are going through a market maker. When an ETF wants to trade one stock for another, oftentimes what they'll be able to do is literally trade that stock for another stock. And by doing that, it's basically foregoing the capital gain on that particular security. So ETFs tend to be very tax efficient, especially when compared to a traditional mutual fund. So with a traditional mutual fund, you really don't have any control over those capital gains or the interest income or the dividend income that you're going to get from that. So ETFs can be a lot more tax efficient. They're not going to completely be able to eliminate the capital gains, but they usually tend to do a pretty good job of that. The last thing that I want to talk about here as we wrap up our discussion about ETFs versus traditional mutual funds is I want to talk just a little bit about some of the portfolios that we typically might see on either side of that, the ETF or the open-ended mutual fund side. So with open-ended mutual funds, we tend to see more active portfolio management, although there can be some passive portfolios on the open-ended side through index funds, but typically we associate those open-ended mutual funds with more of an active approach. So we might have a portfolio manager or a team of portfolio managers that are making their day-to-day decisions on what securities to buy or sell for the portfolio. The ETF side, although they're starting to go a little bit more towards some active portfolio management in small circumstances there, they tend to be known more as a passive investment approach. So they might be more associated with an index or a segment of the market. One of the areas of ETFs that we tend to like with the portfolios that we manage are what are known as factor-based passive approaches. So what they'll do is they'll take an index like a S&P 500 and they'll apply some screening criteria to that index to maybe look for some attributes that they believe are going to be contributing to above average performance. Things like price to earnings ratio, maybe looking for those companies with a low PE, companies that have a better return on assets or maybe have some price momentum behind them. And so, so those types of passive approaches that use a factor-based model can oftentimes have some pretty decent performance there. So, so those are a couple of the differences with that. The last thing I'll say about this is that because of the transparency of ETFs, makes it very easy to piece together portfolios. So if we want to have, for example, a segment of the portfolio that's going to be in healthcare, we can usually find an ETF that maybe goes after that healthcare market, or maybe even a very specific segment of the healthcare market, maybe like pharmaceutical companies, or technology stocks, or internet companies, or semiconductor stocks. So we can really kind of piece together different ETFs to really create the portfolio that we want, unlike a traditional mutual fund where, again, those mutual funds are only required to disclose those holdings on a quarterly basis. So in between those quarters, we may not know exactly what's in there. It could be a technology fund, but it might be loaded up real heavily into semiconductors, and we might like the internet companies better. So anyway, it gives us a little bit more of what we call a pure play. So anyway, that's pretty much it for the video. I hope you got some good information. If you haven't already kind of taken a look at exchange-traded funds for your portfolio, maybe do a little bit more exploring and see if it's something that might be right for you. And don't forget that like or subscribe button, and I'll see you back in one of my next videos. Thanks. Hey, thanks so much for watching this video. And if you found it helpful and you're thinking, hey, this makes sense, and you want to have us help you put together a plan for your retirement, then go to wealthvisionplan.com or click on the link below. When you get there, you'll see some information about our Wealth Vision Comprehensive Financial Plan. If you like what you see on that website, then click on the Get Started Now button, and we'll set up a time to talk. Thanks, and I'll see you back in one of our next videos. Have a great day.